G'day traders, Stacey Burke from Stacey Burke Trading, continuing our discussion on building your best playbook trade setups and just going a bit further now down the rabbit hole in more detail. And in a lot of the previous videos, I've gone over M&W formations. You can go back to YouTube and just Google that. There's lots of overview videos. Today we're going to specifically look at the examples on the charts, and I'm going to try to hammer home the importance of timing. And I talked about trading 1 hour a session or 1 hour a day, depending on where you're located. We'll talk about using the 1 minute charts. Again, I'm mainly trading the 1 minute charts on the majors. It's more about the level. Once you understand the level, it doesn't matter 1 minute, 15 minute, but understanding the timing of when you get in so that you don't have a lot of heat into that position, identifying the best setups, and then just placing yourself into the market, knowing where your risk is controlled. Once they've locked in the high or locked in the low, even if it's with trend, you still want to be trading after they've come back into the trend to hit stops. We talked about the 3-day cycle. All of this ties in together. So we'll take a look at that. So we'll go through some specific examples, and the one concept I'm trying to hammer home is knowing the timings and the setups. Like the people talk to me about the 4 hour trend and the 1 hour and the daily, all these different things. But ultimately what it boils down to is I'm looking for the setup. I'm just looking for the setup at a very specific time. I'm looking for the easy setups. We have day 1, day 2, day 3, day 4, day 5, Monday, Tuesday, Wednesday, Thursday, Friday. There's going to be different templates every week depending on where that currency pair is within the month. We're at the beginning of a month, so we could be beginning a whole new cycle. We could be continuing a second month of trend. We have a lot of conflict in the world. We're seeing some increase in volatility. But all that aside, it still boils down to, is there a setup when I come to the screen for the session? So we're looking at the euro. We'll look at each of the major pairs just briefly. And again, it's about the setups, the setups, the setups, the setups. I don't really care. There's so much technical analysis and all these other things out there. But at the end of the day, what I talked about yesterday is, if you can master some setups and take 25, 50, maybe more, depending on the instrument, a day, and then are they scalable? Are you just getting lucky because you jumped in, or did you actually have a process that enabled you to go to the screen at a certain time with a certain modus operandi to capture a move quickly out of the market, done and dusted? Now that's a different mindset than somebody, trend trading and holding positions and maybe balancing 3 or 4 different systems or positions in multiple markets. That's entirely up to you, but I'm talking about going to the screen, looking for certain setups, knowing which setups I can increase in size that are about to collapse or break down or burst if it's a long trade. Obviously there are other trades. There are trend trade days, but those are trading days where, again, you don't want to be counter trending. So if you're going to get in with the trend, take the move, be done. There will be an end to that move, and we'll talk about timings of that as well. So if we look at the euro, we're looking at this week, and whenever you see a big gap like that, the market opened 100 pips down, that's a bear candle gap. That big move down, that gap to me is one large bear candle. Now we see the creeping trend back up on the Monday. We put a high in Asia, they go up for 3 sessions, they lock it in and go sideways into the gap. Now, this setup right here on the euro is a textbook setup. This is a Viking helmet, a Mickey Mouse helmet, a hat, a Batman head, whatever you want to call it. We've heard multiple names. But it's about the setup. Now, I don't look for setups in Asia typically. The only time I will usually look at Asia, and we'll look at a situation this morning on oil, is when it breaks a daily high or daily low right off the beginning of the day. Now, obviously, they did that on Monday morning. This gap, though, is a situation that I wouldn't be trading other than perhaps looking for the trades back in line with filling the gap. So when I come to the screen, and I talked about using the scanner, and you don't have to use the scanner. but you can look at the scanner to see perhaps maybe which pairs have showed the greatest amount of change in terms of the pip movement. It doesn't, percentage change. I typically will look at this for the week. So first day of the week on Monday, I'll look at the which pairs have moved the most maybe. But as we get to the week, I like to see who's near the high of the week, who's near the low of the week, because that can potentially be looking for a 3-day type setup. Just different factors that you can take a look at. We can look at a new monthly high. We'll just block that out. We can look at a new monthly high to see if anything has come up. Nothing matches. We can see, is there anything making a new monthly low? And nothing matches. So we can just go back to our general scanner, and again, you can add multiple pairs. I'm just looking for simple stuff. I'll typically take a look at the pairs if they've showed a large gain on the day, again going back to the daily, and then during the week I want to see which pairs maybe are at weekly highs or weekly lows, because they could be ideal setups possibly coming together for a 3-day setup. Now with the pairs, what I normally do is I bring up my 1-minute chart, and people don't like the 1 minute in a lot of cases, but I think maybe when you see this, you'll understand what it is that I'm looking for. If you are waiting for a session and you are working off of the high and the low at the end of this session of Asia, that is the high, that is the low. Now my next area of focus is, where are my major round numbers? So we've got a 25 to 35 pip box here, roughly 40 pips maybe. I'm trading between double zeros and 25. The market had broken down the previous day before pulling back in the US. Sorry, this was the euro. We possibly have a peak formation in place for the week. So the high that's in place on the Monday session is telling us perhaps that this peak formation locked in 25. We don't know that, but we know that there's a high in place. They came down below the double zeros and they've put a low in place. When the session begins, again, if we just back this up, I'm looking at the high and the low. Then what I want to know is, what does the first hour do? The first hour is where we can see the market maker, the smart money, the large players reveal their hand. We want to see one of the boundaries broken. Now I know that the challenge for the retail trader is they want to be in this move going out, and that's entirely your choice. These trades can go 25 to 50 pips outside of the Asian range. But ideally what we want to see is exactly what we see here. First hour takes out the high of the day, and on the way puts in a low. The second hour, which is our equity hour, the London session, opens up and proceeds to lock in that low and then come back up in towards the high. Now we had an engulfment in that end of the first hour. So again, the London session opens up top. They come down and put a low in place. This pattern where we come down and put a low in place is going to show up over and over and over again. Now, we talk about trap volume. We now have volume contained in the upper portion of that box. They proceed to auction back up into the quarter level, inside of the high of the day. The next hour opens up and comes back up for 15 minutes. The second 15-minute candle opens up and locks in our M formation at the high of the day. Now, it's really simple. If you just tell time, you're paying attention to two things. Did they break the high or the low? Did they lock in a high? When the equity hour opens, do they come down and lock in a low, a higher low, and proceed back up into the high? They're taking traders back up into the high of the day. The second 15-minute candle opens inside of the already existing locked-in high of the day. They've brought you back up into the high of the day to sell that off. Now again, notice the difference. A very creeping back and forth order flow back into the peak formation for a fast vertical move. This is the types of setups that I'm looking for. We traded into the peak formation high of the week. They put a high in place at the beginning of the equity hour. The London hour locks in a low within that high, a higher low. They creep back up in with creeping trend order flow. Again, study this bull bear, back and forth, back and forth, back and forth into the peak formation, locking in the M formation at the end of the second 15-minute candle. So again, for people who are struggling with which bar do I get in on, where do I get in, as soon as I know, there are two things that I'm looking for. Time to expire, okay? So this first 15-minute candle takes me up. I'm looking for something in that second 15 minutes. But more importantly, I want to get filled above the numbers with the spread. What that means is once they drop away and I've gotten filled with the spread, or at best fill, that this market shouldn't come back. And if there is a pullback, I should be clear of that. And I can go to break even. If I've added in positions, move that second position to break even, whatever that may be. So we have a couple of scenarios. We can look at a measured move target, which is one or two full expansions of that range. Different scenarios. In this particular case, we're in Tuesday at the high of the week, and this market had the potential to, again, break down possibly to the previous day's low. And again, once we got down there, that market proceeded to auction lower and take out 25 pips further past the previous day's low. But coming back to what we were originally talking about, peak formation, they lock in the high of the day. So again, they take out the high of the day. Triggered breakout orders. So now breakout orders are in the market, which typically means they probably have their stop, if they're longer time frames, at the low of the day. That also hits stops possibly on traders that were short from the U.S. session the night before. And again, you'll notice we have volume all contained above the 00 box. They bring it up even higher in the London equity hour, back into the high. There's a large M, but then we also have our smaller M formation at the numbers at the high of the day for a 50 pip move down into the low. Now just taking a quick glance, obviously even on the 15-minute chart, we can see the M formation on the pound, British pound. This is day 2, Tuesday. Again, the pink line showing our Friday, Monday transition. But you'll notice what they did in the beginning of the Europe session. Putting my 1-minute charts on there, again, it doesn't matter like if you're using 4 hour or whatever. If there's a high and a low, the time frame is irrelevant. You're at the high or the low. So heading into the Europe window, again, right at the end of our Asian window, just back this up before the pink box, okay? We have a high just underneath the quarter level, and we have a low. That's it. That's the high and the low. Now, we obviously are contained within a larger bracket, and that comes back to which way did they break to? They broke out, and they pulled back inside. Now, this is the important part. They broke out, and they came back inside. That's a false break. But more importantly is that breakout now has locked in a potential high of the day. And we want to look for behavior that tells us, again, there's trap volume. So we put in a low. The London hour opens, continues to auction and lock in this low and pull back. This is the ideal setup. They come back into traders that are short at the high of the day. So for people who, again, if they're focused on the hindsight, now you're going to see this over and over again. And you're probably going to miss it again, because you're looking at indicators and all these different things. Indicators are going to take you up into the high, even if you're on a longer time frame. 5-minute chart would have been going up. So understand what's happening here, the process. They've triggered breakout traders. They've got shorts in the market on the shorter time frames. They lock in the low, go sideways, and come back up into those shorts. The second hour kicks in for 15 minutes, back up into the high. They engulf it. At the end of the second 15-minute candle, at the previous day's high. This is the previous day's high. So think about what's happening here. They've triggered breakout traders on multiple time frames, 4 hour, daily, 15-minute, hourly, whatever. they're in the market now. And again, they probably have stops below the last hour, below the last 4-hour bar, below the low of the day, all those things. This higher volume trapped where the lows are in the middle of the box. So again, that's 25, that's double zeros. These lows are suspended. They're not at number levels. Market drops back down from the high of the day, which again is the high of the week on this particular situation. Gives us our extended W up top, my little micro W. We'll blow that up a bit. Sorry, M formation. There's our little middle pin for our M structure. The engulfment bear pin hammer, it drops down, goes sideways, and continues to fall straight back down. Now, this is a great setup, again, coming back where the market is traded back down to the low of the bracket from the U.S. session. But also, this gives us a thesis now heading into the next session. This peak formation that happens in the gap time, right here, and then a lower one, and then a lower one, tells us they are trading back up into the highs, which means that the high of the day may already be locked in. This market trades back up into the highs. Here's our low of the day. They come down to the low of the day in the first 30 minutes of the first hour of the U.S. session. Again, this is an ideal situation for a broken down market to be shorting in line with the trend, with the existing broken down market. It broke down in London from the high of the week, the high of the day. We now have a reference point for a U.S. session low of the day. They come back up into the high. What I'll do is mark off the highest bull candle. Okay? That's the peak formation highest bull candle inside contained in those lower highs. The market trades back up into it, trades back up into it, trades back up into it. Now understand the importance of timing again. The New York session, when you see this type of behavior, expect a New York equity session trade. What that means is that when 9:30 New York Eastern Standard Time kicks in, expect for them to come back up into the peak formation high. This is the false 15-minute move at the beginning of the New York equity market. They come up, they hit stops, they pull it back above the double zeros. This forms a peak formation high of the day. This engulfment is anywhere up here is your entry once you know your thesis. You want to get filled again above double zeros, but our engulfment bar is here. First move is going to be back to that middle structure where trap volume is. This is our death line. And then bang, falls through. In this particular situation, the pound continued to trend for the rest of the session. Now, we looked at the Swiss from the previous day's short trade. And again, here's an example of where we just follow the same process. We have our high of the day and we have our low of the day before the Europe window starts. So oftentimes traders will, again, if we think of price as a box, I really sort of encourage to focus on rectangular geometry. Traders will want to be in this move out of the box, which is legitimately no problem at all. If you're understanding you've got to you're in the trade, in the first bar trade, whatever, for the short, with the thesis that this market is collapsing down. They've come up. Again, they've taken out the lower highs of the U.S. session, so they've hit stops, locked in the peak formation high, dropped down, and continued at the end of Asia for the short trade. It breaks out. Now, this is where traders, once they break the previous day's low, they've come 25 pips outside of the initial Asian range to major round numbers, but we're at the end of the 3-hour window. So the 3-hour window in most cases is where you'll get your 3-hour high-low. When they extend outside of that hour, again, we can be at the higher low of the week, which in this particular case we are. Coming back to our 1 minute, I'll be honest, for the most part, I just have my 1 minute charts up, and I just draw my highs and lows. I don't even worry about the other time frames because, again, coming back to understanding, I'm just looking to see, did they break the high or did they break the low? If they break the high, okay, just like they did here, well, I'm at double zeros, I'm looking for a short. If they break the low and we're down at 50, I'm looking for a W down at 50. It's that simple. But if you think you've missed the trade because you're not in this move from the inside, you've missed the point. They took 3 hours to put the low of the day in place. They put the low of the day in place. They make a shortened W formation. It breaks out, pulls back, bullpen hammer engulfment. We'll zoom in on this for an explosive 35 pip move straight back up to the high of the day. So again, this is an example of where it's moving prior to the London equity market open. They put a low of the day in place. The equity market hour puts a low of the day in place. What do? They go back and hit the low one more time. So just because they put a low in there as opposed to putting a high in, they come back underneath, 1 push, 2 push, 3 pushes, and then they hit the low one more time. They lock it in, breakout pullback. Some traders would have been long right off the bottom on the pin hammer. Again, breakout pullback, new hour. This is a new hour. That's the low of the hour, bullpen engulfment for the explosive move back up through the high of the day. And we'll talk a bit more about timings in one of the next couple videos, because timings are key when you have a market that moves strongly in Asia or London. So again, we talked about the 3-hour window. When they extend out further, again, they're going to put a high or a low in place. But if you understand the timings of these moves, so we get to the end of the 3-hour window, and this market actually puts a peak formation low in and continues to auction up for another hour. Now, coming back to when this move began off the bottom, this move began at the London hour. So that's the 4 o'clock New York Eastern Standard Time, 4 to 5, 5 to 6, 6 to 7. That's 1, 2, 3 on the hourly. So at the end of that third hour, it's possible we might be getting a high put in place. This is exactly right at the end of the third hour. Now we're at major round numbers for 50. They come down, this is in the gap time, and they lock in the high currently at this time, 50 and double zeros. Now, this is where traders can capitalize in some situations before the market opens. You don't have to necessarily be and try to catch the high. We just want to know, have they locked in the high in the gap time? If they have, are they coming down and locking in a low for a move back up in New York? Or are they pulling back into the high, locking in the high of the day, and then in that last 30 to 15 minutes of that hour prior to New York, is there a trade possibly setting up for a stop hunt? And this market, you could flip this whole pattern back over for a long trade as well, the exact same pattern. They could have went down 75 pips into this trade, but they went up, locked in the high, peak formation, time decay kicking in. We're into the last hour prior to the New York 12 candle window opening. They hit the stops, trigger breakouts. The high's already locked in. We've already locked in the high. These lower highs are inside of the peak formation, and we get an explosive 100 pip move stop hunt through the London trader session. Again, the new session kicks in. They come up and lock in a new high for the U.S. session, and then they proceed to auction down for the next 40 minutes. So we're up here in 15 minutes and a bit, and then the next 3 15-minute bars auction down and reverse. That now potentially may be locking in our low for the U.S. session. We're already in a strongly moving up market. This is the existing high of the day now. We have our pin low. They come down inside of that pin and reverse and lock in our low of the day. Now again, if we were just looking at major round numbers and timings, at this stage, I'm looking for a New York equity session possible trade. This is 2 minutes before the New York market opens. This engulfment after the stop hunt down. Thesis being now is I want to get filled underneath double zeros. They've locked in the low beneath 75, so I want to get filled somewhere better than double zeros. Explosive move back up to the high of the day. The high of the day is just above 50. Just doing some simple math, you want to get filled 50 pips at least below that high, including your spread and maybe, a couple pips for them to just pin up and pull back. But again, the session begins. We have our high of the day. That's our current high of the day. They go down and hit stops. They've already hit stops on the bottom. There's a pin. They go up and put a high in place and proceed to auction down into the low of the day and give us our W formation, our shortened W formation at the low of the U.S. session at the end of the first hour. This move back up breaks structure. They put in 3 little peaks in a creeping trend to lock in 75. 2 minutes before the equity markets, traders were already long at 75. Little breakout pullback, putting heat into those traders that are long, and then the move back to the high of the day. So the process is the same. All I want to do is mark off my high and low. We can look at the euro yen. We can just purely look at our highs and lows. We have a high put up in Asia. We have a low put up in the gap, which is just towards the end of the Asian window. Now again, this market broke down below zeros. We can put our lower highs, peak formations underneath of that peak formation. The market auctions up in the Europe window right off the bat. Now, it went up. It went up. That's why I can draw that line on those lower highs. Okay, so we know that this is the first bar of the Asian window that dropped down. They came back and pulled underneath. This lower high is our strike zone area if we're going to see this fail. If it breaks through there, well, obviously that thesis is wrong. But this first pin that they put in place 30 minutes into the session gives us our thesis now that they could be putting a high in place above that level into the peak formation from Asia. They drop down, and then we see the pump. That's our pump and dump. Again, we're above double zeros, between double zeros and 25. What I'm looking for in this first hour is for them to lock the high of the day in place, which we see. London opens up right at the high of the day, proceeds to auction down. That breaks structure. That breaks structure on these higher level longs, and they put a low in place in that hour. And then the second hour opens up right near the high above double zeros, giving us our engulfment inside of an existing peak formation after the high has been locked in. Market drops down and proceeds to fall. So again, double zeros, just keeping it in simple terms, double zeros, I'm looking for them to possibly fail up above the double zeros into the peak formation. I want to get filled above zeros at best, fill as best I can. An early entry could be taken in here, knowing though that they will come back. They're going to possibly lock in trap volume up top in that middle equity hour, locking it in one more time at double zeros. I want to get filled above double zeros. My thesis is that this will at least retest the existing low of the day. If it's a strong move, we can get a measured move. And again, that thesis can carry through into the U.S. session, which we saw them do. They came down for 15 minutes, reversed it in that second 15-minute candle, came back up for the stop on up, and then resumed the move down. So even taking a long trade, double zeros for 25 back up. Again, if we zoom in on that, depending on how traders wanted to trade, there's a W formation, second 15-minute bar. Right at the end of that second 15 minutes, we get this consolidation at double zeros at the low of the day, the engulfment, the retest, and then the second engulfment right above the numbers for the explosive move back up. A dead giveaway on this type of trade setup is the lower highs below the numbers. That means anybody who's shorting this, chasing the move, there's a gap, and those lower highs are going to get exploded through. That also creates a level to layer on top of if they're going to go further back up, and that actually came back up to where the expansion peaks were put in place. Is every day, every pair going to offer a textbook setup? Not necessarily. That's why you want to hunt the best setups. Gold, oil, NASDAQ, major currency pairs. There's going to be at least one or two every session pretty much, aside from Asia. But, again, letting Asia and London set up. that can give you a very strong thesis heading into New York. And if you're keeping that to 1 hour, understanding that that equity hour can itself be the setup once they lock in that higher low. So the cleaner the setups, the simpler and stress-free your trading can be. And again, just focus on the setup, not the pair. People are transfixed sometimes with following one or two currency pairs, and gain day 1, day 2, day 3. Today's a Wednesday. We could be in a chop day. We could be in a range bound day. It could be a trending day. Time will tell. But letting the market set up, again, even worrying about trying to get pips every day, focus on the best setups and then scale them up in size. And taking even 2 or 3 of those a week is more than enough if you get that to a certain size. So hopefully you got value from today's video, traders. Review some of the other M&W formations at type 1, type 2, type 3. We saw some examples of pretty much all of those today. They're in the charts. If you're working from the high and the low, again, the 1 minute chart can pretty much give you as much information as you need if you're looking for that small window of movement. Again, if you're trading, looking for different types of setups, then obviously the longer time frames might be more suited to you. So hopefully that helped out, clarified some questions. Have a great trading day, and may the markets go
Hi
with you.
traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.